option traders. For today's trade, we're looking at a bull call spread in home construction company Lennar. So let's take a look at the stock on MarketSmith. Lennar is trading above a 5% buy zone after breaking out from a 95.34 entry of a cup with handle base. Shares have been trading bullishly above their 21-day line since October of last year. Currently, the stock is roughly 9% extended from the buy point. While Lennar's most recent earnings and sales growth decelerated from the prior quarter, the stock is still showing double-digit growth in both categories. Also, Lennar is part of the number 5 industry group out of IBD's 197 groups. This is a high rank and shows leadership among residential and commercial builders right now. Given that the stock is looking bullish, but shares are currently extended from their 5% buy zone, it may be hard for investors to want to chase this one right now. We often talk about not chasing stocks once they become extended. But what if there was a way we could get bullish without having to buy the stock? This is where the bull call spread comes in. A bull call spread is a debit spread and a risk-defined way of getting long. It's one of 4 basic vertical spreads that you can put on using options and involves buying a call and selling a call with a higher strike price. The goal is for the stock price to stay above the higher strike price to profit the full amount. If the stock price is below both strikes, then the maximum loss will be realized. Since volatility in Lennar is still quite low, it makes sense to put on a debit spread rather than a credit spread. So with all that said, let's take a look at my trading platform and set up a trade in Lennar.
So looking at Lennar here on Thinkorswim, using the June 16th expiration, we are looking to buy a 105 call, and then we are looking to sell the June 16th 110 call. And together this creates the bull call spread.
Using the June 16th expiration, we can buy a 105 strike call and sell a 110 strike call to set up the bull call spread. In total, this spread will cost around $240 in premium with a maximum gain potential of $260. A bull call spread is a risk-defined strategy, so if Lennar stock closes below 105 on June 16th, the most the trade could lose is roughly $240 or the premium paid. Potential gains are also capped above 110, so no matter how high the stock price goes, the most the trade could profit is $260. The break-even price is equal to the long call strike plus the premium, which in this case would be $107.40. In terms of trade management, if the stock drops below the February 10th low of 100.04, you might consider closing it early for a loss. One more thing to keep in mind is that there will be an earnings risk with this trade, as earnings for Lennar are due mid-March. As always, remember that if you're new to options, make sure that you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment in some cases. Check out the new Options Trader app from IBD for digestible education and tons of great options trade ideas. And be sure to join us here for our regular options content where we break down a new trade idea every day.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.